Good afternoon, everyone, and welcome to a webinar hosted by Bernie Wealth Management. My name is Bijal Patel, and I'm a Senior Wealth Advisor on the team here. I'm joined by my colleagues Adam Newman and Kyle McFarland, along with other members of senior management. We thank you for taking time of your day today to join us. Before we jump into the content prepared for today, I'd like to go over quick housekeeping items. First, we've allotted 1 hour for the webinar. The first 50 minutes being content presented by our team and the remainder of the time for Q&A. Questions can be submitted throughout the presentation, but to keep to our schedule, we'll hold off on addressing them to the end of the presentation. You can submit your questions by selecting the Q&A icon on the top left-hand corner of your screen. Any questions that we don't get to by the end of today's presentation will be addressed as part of follow-up with you, which will be outlined before we close things out. Thank you for joining us today. Adam, you now have the floor.
Thanks, Bijal. Welcome again, everyone, and thanks for tuning in today. Today, we're going to help you maximize your retirement income, and we're going to do this by helping you fully understand the Social Security system and helping you determine and identify an optimal claiming strategy. And I want to kick things off by really highlighting how things have changed over time with regards to how individuals are making decisions and strategizing around their Social Security benefits. So when your parents and grandparents retired, they probably didn't think too much about Social Security. Typically, an individual or a couple would go down to their local office as soon as they turned 65 or maybe even 62, and they applied for benefits. They took these benefits for granted, and they didn't really ask very many questions. And what's happened over the years, especially with longevity, with people living longer, and with the retirement landscape changing with regards to the free flow of information, baby boomers are approaching and tackling the Social Security claiming decision in a much different way. And we're going to structure this webinar and the curriculum here by breaking this down into 5 questions, which we've accumulated and identified as being the 5 most common questions related to Social Security. And we're going to follow these 5 questions by talking about 5 strategies that you can implement to optimize the benefits that you receive over your lifetime. So let's get started right away and look at these 5 questions in list form, and then we'll break these down individually. But the 5 most common questions we've identified that baby boomers want to know is, number 1, will Social Security be there for me? This is really intensified over the years of this conversation, especially in the political arena, as budgets are being rolled out and tax reform is being discussed. Boomers really want to know, is the system going broke? Is it funded? A lot of rumors. We're going to try and demystify some of that for you today. Number 2, how much can I expect to receive? So you get your benefit statement. You may or may not have seen it recently, but people really want to get a good handle on what the income stream is going to look like. We'll give you some background around how that's calculated and how you can estimate your benefit based on any future changes. Number 3, when should I apply? So as you may or may not know, the age at which you apply for your benefit will fluctuate whether you claim before or after a certain full retirement age. Number 4, how do you maximize these benefits? So are there strategies or things that could be done to really tap into the full value of the system and make sure you're getting what you're entitled to? And then lastly, number 5, in the context of a comprehensive retirement plan, will Social Security be enough to live on in the future? Before we hop into those questions, I want to try and apply some numbers to the long-term value of Social Security. And we're going to look at this on both a monthly and a cumulative basis, but most people tend to minimize the value of their Social Security benefit. And if they understand that they are likely to get something back from the system at all, they often think it'll be something minimal and something not really to count on. But in reality, Social Security is far more valuable than many people realize. This chart here is going to quantify this. So if your monthly benefit is a flat $2,000 a month as of today, and you live 10 more years, 20 more years, or 30 more years, you can see what the cumulative lifetime benefit will be in terms of dollar amount. So if you live 10 more years from today with a $2,000 a month benefit, you will have fully captured just over $300,000 in cumulative benefits. If you live 20 more years, it's just over $650,000 in lifetime benefits. And if you live 30 more years, it's just over $1 million. And what we've seen and what happens each and every day as we're working with clients is with couples and individuals living longer, it's much more likely that the decision that you make will compound to something fairly significant over time, something in the tune to several hundred thousand or even approaching $1 million. Second, and this is really important to really note in terms of the timing around when you begin claiming benefits, is the concept and the idea of the cost of living adjustment. So what happens is the day you start collecting, you receive a flat dollar amount, and then each and every year, the government comes back and they report an annual cost of living adjustment that will be applied to your benefit for the next year. And if we look over time, if we use averages and look long term, the average annual cost of living adjustment to your benefit, it lands somewhere around 2.6% per year. Now, I know more recently with the inflation environment and how that's factored in with the interest rate world that we live in now, these adjustments have been zero or something much smaller, but in context of longer term planning, it's important to know that these, the average has been just over 2.5%. So using the same idea of looking 10, 20, and 30 years down the road, you can see what that same $2,000 a month benefit will grow to over different periods of time. So 10 years from now, that $2,000 a month benefit will now be $2,585 a month. In 20 years, that same $2,000 a month benefit will be $3,342 a month. And in 30 years, that same $2,000 a month benefit will have grown to just over $4,300. So significant impact that inflation plays on your benefit and makes that timing and the dollar value of the decision you make that much more relevant. So with that in mind, and with really a full understanding of the importance of the decision around Social Security and the dollar impact, let's hop into question number one, which is the big one: will Social Security be there for me? As I said earlier, many clients are worried about this. We hear it each and every day. It's led to a lot of misunderstandings and irrational fears about the solvency of the system. So what we're going to do is we're going to put some numbers behind this and try and quantify the issue of fully or partially funding Social Security. What I have here on the screen is it is a summary that we're going to walk through and show you if the system's over or underfunded. So Social Security was designed as a pay-as-you-go system. So the way it works is payroll taxes from current workers go into a trust fund and they're immediately paid out to current retirees. So if you're working and as you've been working, you've noticed Social Security taxes come out of your paycheck. That goes into a pool and it's immediately paid out to retirees that are collecting. So it's money in, money out. And what's happened is because baby boomers have been in their peak earning years, the trust fund has accumulated much more than what is needed for current benefits. So right now, the trust fund holds about $2.8 trillion, which they invest in what they call special issue treasury securities, so very low risk investments. And as baby boomers start retiring, these trust fund assets are going to be drawn down. So that's the snapshot, 2.8 trillion, more than fully funded. But let's look at this over time. The same institution that monitors the ins and the outs, they put together a long-term projection. And what this projection shows is that over the next 75 years, costs are going to start to exceed the income. There are enough reserves so that the system will be able to pay 100% of promised benefits until about 2034. And after 2034, what's going to happen if there's no reform implemented in the system? Income at that time is going to be sufficient to cover just about 80% of promised benefits. So this is where the conversation happens in the political landscape and out in the financial world around the need for reform and how it needs to be done sooner rather than later. It's not an imminent threat to Social Security, but it's something long-term that has to be adjusted based mainly on demographics. So here's a listing of the reform proposals that we've seen been studied. This actually comes from the American Academy of Actuaries. They have a website. It's actuary.org, where you can access and tap into this information and read some of the reports in more detail. But here are the 4 big ones being discussed now as possibilities. Number 1 is to increase the maximum earnings subject to the Social Security tax. So today, the first $127,200 of your income is subject to a 6.2% tax paid by both you and your employer. So it's a double tax hit on the first $127,000. Anything over and above that, the tax does not apply. So what they're talking about is saying, let's make this number a little bit higher to get more tax revenue. If you're self-employed, you get hit on both ends of that, and there's a lot of really good tax planning opportunities where you can minimize that we could talk about. Number 2 is just to raise the normal retirement age. So we're going to talk about this in a lot more detail as we move ahead, but in simplest terms right now, they're talking about raising this normal retirement age to something that surpasses the peak current age of 67, and raising that to something like 68 or 70, depending on what proposal you look at. Number 3 is the lower benefits for future retirees. So they're really talking about grandfathering in a certain group, and then for the next generation, applying a less favorable formula and lowering the potential benefit. And then number 4, to reduce those cost of living adjustments for all retirees. So we talked about that average being 2.6%. What's being discussed is capping that at some percentage point or lowering it altogether. So as I said, actuary.org is where you can go if you want to read a little bit more about these proposals in more detail and see what may or may not impact you. But I think the bottom line, the big takeaway, and we feel really confident in saying this, for those looking to currently retire, it's very unlikely that your benefits are going to be affected by any Social Security reform. And again, we don't think there's any immediate worry of your benefits being reduced significantly or cut altogether. Question number 2, how much can I expect to receive? So now that we've addressed the solvency issue, what we want to do is help you take a look at how much you can expect to receive from the system. And there's 2 ways that this is calculated. 2 inputs go into the decision around what your specific benefit's going to be. It's going to be, number 1, how much you've earned over your working career, and number 2, how much, what age do you apply for benefits? So those are the 2 inputs, and here what we have is a more specific outlining of how these benefits are calculated. So at age 62, what the Social Security Administration does is they look backwards. They look at the annual earnings over your entire lifetime, and they index them for inflation. So that just brings everything in today's dollars, and they make a ranking of every single year of your earnings. This total, so this indexed earnings total, is then divided by 35 to come up with an average. So if you don't have 35 years of earnings, what they do is they fill these missing years with zeros. This has an effect of lowering Social Security benefits for many women, especially, who had taken time out of the workforce to raise children over the years. But these same individuals might be eligible for spousal benefits, which we'll cover in a moment. So what happens then is, again, 35 years index totaled, and then divided by 35 to get your annual average earnings number. And then what they do from that point is they apply a formula to that dollar amount, and that's going to represent what they call your PIA, your primary insurance amount. And this is the amount you'll receive when you reach your full retirement age. So if you were born between 1943 and 1954, your retirement age is 66. And then again, in a minute, I'm going to pull up a chart and we'll look at what that full retirement age will be for each subsequent year. But I know I just went into a bit of detail. I'm going to use an example to maybe help clarify some of this. So here's an example of a benefit formula. We've got a baby boomer born in 1955. This individual earned that maximum Social Security amount every year since age 22. So earlier I said the 127,000 is the cap for the Social Security tax. So what that's saying on the second bullet is this particular individual earned that cap each and every year from 22 on. And then what we do here is we average the index monthly earnings out, and that's where we get the 97.84. So if someone born in that year earned the cap every year, and we apply that index, you get that $9,784. And then down below, we show how this, if the formula is actually applied to calculate your monthly PIA, that primary insurance amount. So we don't need to get into why certain brackets or certain percentages are used. This is a mystery, just like a lot of the tax code. But what it's doing is it takes your average index monthly earnings, different percentages are applied to different dollar amounts, and the number here that's spit out is $2,888. So that's the number that would go on the top right of this retiree's Social Security statement. So next time you get your statement and you see that number on the top right-hand side, just know that this is some of the math that goes into that calculation. It's complex, but really what it is it's some average of your lifetime's worth of earnings, and then an index is applied. So as we said, full retirement age is the age at which you can claim full unreduced benefits. So it used to be 65 for everybody, but now we're seeing a higher full retirement age being phased in as a result of amendments that occurred in 1983. So for everyone born between 1943 and 1954, full retirement age is 66. And for everyone born 1960 and later, full retirement age is phased upwards to age 67. So for those born in 1955 through 1959, full retirement comes out to be age 66 plus some number of months. So based on where you land, you can see what your full retirement age would be. This is important. Why? Because this will impact the function of your benefit if you apply before or after that full retirement age. So if you apply prior to your full retirement age, you're going to ultimately be entitled to a reduced benefit. You're going to receive a percentage of that primary insurance amount depending on when exactly you apply. So as you can see here, if your full retirement age is 66 and you applied 62, you're going to get 75% of that primary insurance amount. At 63, it bumps up to 80% and so on. So if your full retirement age is 67 and you ultimately applied 62, you're only going to get 70% of your that PIA. So these amounts are actually prorated monthly. So you can actually you can apply any time after 62, and your benefit's going to be reduced by the appropriate amount. It's not an annual calculation. They actually go out and prorate that on a monthly basis. So this is significant. You can see, especially again going back to the idea of longevity, this can compound and really turn into something very real in terms of dollar amounts. So on the other end of this, what if you apply after your full retirement age? And this is where the government does something that it normally doesn't do, is it guarantees you some sort of positive future change. And what that is it's an increase of 8% per year in that primary insurance amount. So if you apply anytime after your full retirement age up to age 70, it's 8% for each and every year. So if that full retirement age is 66 and you applied 67, your benefit's going to be 108% of your PIA. At 68, it'll be 116%, and so on. So one of the things to mention here is that once you surpass age 70, there's no future increases, no delayed credits are applied. So 70 is really the age at which you cap out on what you can take out of the system. So now that you know some of the math behind this and the impact on claiming early versus later when it comes to your full retirement age, I've put up here just 3 bullet points and places that you can go to estimate your benefits. So if you go through the Social Security website, they've got calculators that you can use. You can plug in different assumptions. They tend to be a little bit generic in nature, but as we move through the presentation, I'll talk a little bit more about what we're able to do on our end, and how for everyone attending today, we can run a more complex benefit calculation to help identify your optimal claiming strategy. So now that we've got a good handle on understanding the value of Social Security, knowing the math behind calculating your benefit and the pros and cons of claiming earlier versus later, I want to tap in just briefly to 3 sub-benefits provided by the system that I think commonly, apply to the population. They are spousal benefits, divorced spouse benefits, and survivor benefits. So spousal benefits were really put in place a while ago, again, to help compensate spouses that have been out of the workforce because they were, helping build a family, and they maybe didn't pay into the system to the amount where they would get a respectable benefit. So this was instituted in an earlier era where a lot of married women didn't work. And so what was put in place is the idea that a spousal benefit will be 50% of the primary worker's PIA if he or she applies for it at the time of their full retirement age. So just as an example here, if John had worked for many years and his primary insurance amount is $2,000 a month, and if Jane's, who was the spouse, her PIA was $800, when she goes to apply for Social Security at her full retirement age, she would actually get $1,000. She would get half of John's $2,000 instead of her $800. So it would be bumped up to account for the spousal benefit adjustment. And so there's 3 rules for being able to do this and claim and use this strategy. Number 1, the primary worker must have already filed for benefits. Number 2, the spouse must be at least 62 for a reduced benefit and 66 for a full benefit. So there's age constraints to this. And lastly, unlike your personal benefit, with the spousal benefit, you will not receive any delayed credits after age 66. So there's no benefit to waiting past full retirement age. Next is divorced spouse benefits. So it works very similar to just regular spousal benefits, but again, several rules apply here. Number 1, the marriage needs to have lasted for 10 years or more. Number 2, the person receiving the divorced spouse benefit, they need to be currently unmarried, so they can't have remarried. Number 3, the ex-spouse needs to be at least age 62. And number 4, if the divorce was more than 2 years ago, the ex-spouse does not need to have already filed for benefits. So like the spousal benefit where we said the primary working spouse had to have already applied for benefits, with divorced spouse benefits, that's not the case. Some other rules here when it comes to divorced spouse benefits. So more than one ex-spouse can receive benefits on the same worker's record. There's no limitation. So if there were multiple marriages and you qualify, you can claim multiple benefits from ex-spouses. The benefits paid to one ex-spouse, they don't affect those paid to the worker, the current spouse, or any other ex-spouses. So there's no offsetting done, no adjustments made. Whatever you're entitled to, you'll be entitled to. No one is penalized for you claiming divorced spousal benefits. And then lastly, these divorced spouse benefits, they would stop if there was a remarriage or if the divorcee had accumulated enough credits to collect their own benefit that's more favorable. So you can't double dip like many things. So lastly here, the third sub-benefit, we've got survivor benefits. So these benefits can be somewhat complicated, but I'm gonna really highlight high level to give us an understanding of how they work, because the decisions you make now around the timing of when you claim, they can have a significant impact on the amount of the survivor benefit later on. So there's 2 factors that impact the amount of your survivor benefit. The first factor is the age at which the deceased spouse originally claimed his or her own retirement benefit. So if he originally applied for Social Security before full retirement age, the survivor benefit will be limited to what his actual benefit was, so claiming early, it's a reduced benefit, or 82.5% of what the PIA was, whichever is higher. So it's a little complicated, but essentially what it's doing is saying you're either going to get this reduced amount or 82.5% of the PIA. That gives some protection to survivors, you know, in the event of a premature death. If he applied at his full retirement age, the survivor benefit would equal 100% of the PIA. Like I said, it's just passes directly down. And then lastly, if he applied at 70, the survivor benefit will include the delayed credits, and I've got an example in a moment to show that. So what the system is designed is something where it can benefit surviving spouses. The second factor influencing the amount of their survivor benefit is the age at which the widow actually claims the survivor benefit. So if she claims it at 60 or 50, if he or she is disabled, the survivor benefit is going to equal 71.5% of the decedent's primary insurance amount. So we're claiming early here, we get a portion of whatever that PIA was. If he or she claims at full retirement age or later, that survivor benefit is going to equal 100% of the original amount. And then obviously, you can apply any time between 60 and 70, and that reduction is prorated. So there's a lot going on there. I'm going to give just a quick example to capture this. We've got Joe and Julie. They're married. They're both over full retirement age. Joe's benefit is $2,000 a month. Julie's benefit is $1,200 a month. So Joe dies. What Julie does is she goes and she notifies Social Security, and her $1,200 benefit is replaced by her $2,000 survivor benefit. So really important here, just like I referenced earlier, no double dipping allowed. You get one or the other, you get the higher of the two. And let's take the same example and let's assume that there was early claiming involved. So again, same base facts here. Joe and Julie are married. Joe's primary insurance amount is $2,000 a month. Joe files for Social Security at 62, so his benefit's going to be reduced, like we said earlier, 75% of that amount, so it's $1,500 a month, and Joe dies. So Julie's survivor benefit's going to depend on when she claims it. So if she claims her survivor benefit at 66 or later, her benefit's going to be 82.5% of Joe's original $2,000 benefit. So instead of getting $1,500, she's going to get $1,650. And if she claims her survivor benefit at 60, it's going to be that reduced amount that we discussed. So different moving pieces here, but the idea is that two things are going to impact the amount of the survivor benefit: when the deceased spouse started claiming originally, and then when the survivor decides to claim. Just walk away with that. There's two inputs into that decision. And then lastly here, a quick one with delayed claiming. Again, same base facts, but we're going to assume that Joe had delayed and had a higher benefit. So Julie's survivor benefit is going to be equal to Joe's benefit of $2,640 a month. And if she claims, again, going into the timing, if she claims her benefit at 60, it's going to be a reduced based off of that amount. And if she claims at 66 or later, she'll get the full amount of what Joe had received. So very important to understand that there's two moving pieces to that output and that decision. So survivor benefits, like anything, we've got rules, just 4 quick rules here. The couple needs to have been married for at least 9 months at the date of the death. The survivor must be at least 60 or 50 if disabled. So that's the floor, that's the minimum age at which you can start to collect survivor benefits. A survivor benefit is not going to be available if the widow or widower remarries before age 60, unless that marriage were to end at some point. Then you could circle back and recollect. And then lastly, divorced spouse survivor benefit is available if the marriage lasted at least 10 years. So again, like anything, I use the tax code as an example. You're noticing lots of ins and outs here. It's a little bit complicated, but just know that there's rules that need to be followed and different inputs to each of these decisions. So we're moving along to question number 3, which is the big one. We get this each and every day. When should I apply for benefits? And what I did here is I made a list of a number of items that we think most readily apply. So the major inputs and considerations in determining when to apply for your benefits are health status. So what's the current state of the health for you and your spouse? Life expectancy, think of things like family history. Need for income, what are the resources do you have to fill your retirement income need? Your investment portfolio, what's the size of your portfolio? What's your distribution amongst different types of resources? So between your taxable accounts, your tax deferred, and your Roth accounts, what does that look like? Whether or not you plan to work, that could be full or part-time. And then lastly, the needs of the survivor. So survivor needs and personal needs really hammer home the need to heavily consider delaying benefits to collect not only bigger checks early, but bigger checks down the road. So the obvious advantage to delaying, as you see in this chart, is that your monthly benefit to start will be a lot higher. A baby boomer who's 62 now and has a primary insurance amount of $2,600 a month would receive a reduced amount of $1,950 a month if they applied at 62, but $3,432 a month if he waited until age 70. So huge difference. That's an 8-year difference, but look at the gap in benefit. This difference becomes even more dramatic if we multiply these amounts by that 2.6% annual cost of living adjustment. So if we do that, you see in the last column there, if we apply those COLAs to the benefit, you notice an even bigger difference, $4,200 a month versus $1,900 a month. So that's significant. And this really factors in to the longevity discussion. So you can see on this chart benefits at different ages, and then what the impact is if claimed at 62 versus 70. So let's go down to age 100. You can see it's with the cost of living adjustment in mind, almost double the benefit. So really significant and makes a huge impact. The timing is incredibly important. So some key points to remember when it comes to applying for Social Security. I've got 3 here. If you apply early, your benefit's going to start lower and it stays lower for life. Number 2, the cost of living adjustments magnify the impact of earlier delayed claiming. So the longer you live, the more beneficial it is to delay benefits. And the follow-up we do and the analysis that we run personally to you is going to help quantify this and put a cumulative amount to that dollar amount. And then lastly, the decision is going to impact your survivor benefits. So delaying benefits might give your surviving spouse significantly more income down the road. Question number 4, how do I maximize my benefits? So we've got these 5 strategies. We're gonna run through them. Some of these will be very simple and intuitive, other a bit more complex. Strategy number 1 is fairly straightforward. Improve your earnings record. So the first thing that you can do while you still have time is to check your annual statement to make sure your earnings record is accurate. I can't tell you how many times I've seen this. It's something that's not incredibly frequent, but it actually does happen. What you can do is through your statement, you can see your annual earnings history, and you might find gaps or mistakes based on what was previously reported. And if you correct something, it can make a positive impact on your primary insurance amount. So you need to consider also from a retirement decision standpoint, that question of when do I retire? I talked earlier in the presentation about needing to have 35 years of earnings history for that index calculation. And any years that don't stack up to 35 are filled with zeros. So if you've got 30 years of work history, you'll get 5 zeros that get applied to that calculation, and that can significantly reduce your benefits. So you want to understand the impact that working another year or 2 will have on that benefit and what it might mean for you. So is it accurate? Any missing years? And can you improve it by working longer? Strategy number 2 is get the claiming decision right. Apply at the optimal time. So you're going to need to consider several things to make this happen. You need to look at your income needs, both now and in the future. Consider your life expectancy for both you and your spouse. And lastly, consider the allocation of your resources. So you might have taxable accounts, you might have tax deferred accounts, and you might have Roth accounts. And what happens is, in isolation, you might think that delaying till age 70 makes perfect sense. But when you look at everything together and how the different moving pieces of the puzzle work in coordination, it might be determined that claiming earlier is actually more beneficial because you might be needing to take money out of tax deferred accounts and paying a big tax bill. So little things like that can really trip up the optimal claiming strategy. But again, as part of our follow-up, we'll help you look at some of this, but it's really just important to know it's not a decision made in isolation. This is a decision that's made in coordination with your overall plan. Strategy number 3, and we've talked about spousal benefits. You really want to coordinate these, and this has changed a bit over the years. But the goal is to maximize income for both of you, for you and your spouse while you're alive, and to maximize income for the survivor as well. It can be pretty complicated, but if we can help you understand all of the considerations and do some calculations, it's possible for married couples to come up with the right solution. So we're going to talk about a couple of strategies that can help you get the most out of these spousal benefits. Number 1, so the first thing to look at when you're coordinating spousal benefits is this. Is the lower earning spouse's primary insurance amount, is it more or less than 50% of the higher earning spouse's primary insurance amount? So if the lower earning spousal benefit, if the spouse's benefit is more than 50% of the higher earning spouse's PIA, the way to maximize lifetime benefits typically is for both just to delay to claim their benefit until age 70 and maximize those delayed credits. Our analysis and the work that we're going to do for you as follow-up is going to help show that if both spouses have an average or longer than an average life expectancy, this will typically help maximize the benefits for both of you over your lifetimes. And then, depending on the ages of the spouses, one spouse might be able to claim a spousal benefit between 66 and 70. The rules have changed recently on this. You probably heard a lot about file and suspend, which went away for the most part. But if you were over 62 at the end of 2015, you might be able to claim a spousal benefit at age 66 while your own benefit builds delayed credits till 70. So that's something we'll talk about on an individual basis, whether or not you're grandfathered into those old rules. And if so, it can mean tens of thousands of dollars in extra benefits. The next is a hybrid strategy. So we talked strategy number 1, which is both delaying if the lower earning spouse's PIA is more than 50% of the higher earning spouses. But here's a hybrid strategy where the lower earning spouse's PIA is less than 50% of the higher earning spouse's PIA. So what happens here is the lower earning spouse goes ahead and claims early. So this gets income started as soon as the lower earning spouse turns 62 or whenever they stop working. And then the higher earning spouse is just going to continue to delay at 70 and maximize those delayed credits. So it can be very, coordinating this can be a little bit tricky, but essentially the idea is you're getting some income in the door early, even though it's a lower amount, and you're helping delay that future benefit to something larger down the road. And again, we talked about it, that helps with the survivor benefit. So it could be a real game changer long term. Strategy number 4 is going to talk about taxes. Nobody likes paying taxes, and there are, in fact, ways to minimize the taxation of benefits. So I'm going to pull up a table here that's going to show the taxation of Social Security benefits based on the various income levels. So income in this case, it means something what they call provisional income, which includes your adjusted gross income plus 1/2 of the Social Security benefit plus any tax-exempt interest, clear as mud, right? So that's your adjusted gross income plus 1/2 of your Social Security benefit plus tax-exempt interest. So if it's under $32,000 for a married couple, then no benefits are subject to tax. And you can see here on the chart at different levels what the taxable amount will look like. And I got the formula there on the bottom on what provisional income is. So a lot of investors have control especially in retirement, around their tax brackets, and things can be done to shift things around to keep you within, certain bands to help manage taxes. But the idea of provisional income and monitoring that can really be a positive. And I've got a list here of ways to minimize taxes on Social Security benefits. So 6 things here, I'll walk through them. Number 1, reduce the income with tax advantage investments. So you want to reduce income from other tax advantage investments to take care of that whole idea of the provisional income. So that's number 1, really important. Number 2, anticipate IRA RMDs, and this goes into this concept that I've been talking about frequently, during the presentation of what do your buckets of resources look like between taxable, tax deferred, and Roth. And we know with tax deferred accounts, you have to start taking RMDs at age 70 and a half. So if you can anticipate this and implement strategies early on to try and lower that in the future, that could help reduce the taxes you pay on Social Security. And that ties right into bullet number 3. One of the things you can do is convert traditional IRA money to Roth to avoid those RMDs. Number 4, delay Social Security. So that will reduce the number of years benefits are subject to tax. Reduce expenses, so paying down debt, adopting a simpler lifestyle, reducing that income need that can, and the cost can help reduce Social Security taxes. And then lastly, just be mindful, especially at the investment strategy level, on your overall tax situation. Are you invested in a tax efficient way? Do you have the right types of investments and the right types of accounts to help account for the different buckets and their tax treatment? So it's not so simple as just saying, okay, I'm at this age, I'm going to get my benefit. You can optimize, and you can do so in a way that will reduce the amount that you pay on Social Security benefits. And this is really where we get into strategy number 5 in terms of coordination. So you want this Social Security decision to be done in the context of your overall financial plan. So we had talked about things like pensions, IRAs, 401ks, RMDs. All of these resources should be coordinated to give you the income you need for the rest of your life. Again, as part of our follow-up, we're going to help you tackle some of these items, and we're going to do so by addressing some of the really big questions that come with it. And I'm skipping ahead a bit, and I'm going to bounce back. One of the things that I wanted to list out are some of the really important questions that we think you should be asking yourselves right now. Not only when to apply, if you should keep working, how long, and what's the dollar amount you should be earning? What if you've already applied? Can you make any changes? Can you retroactively change your decision? If you meet certain requirements, you can. How much will the benefit be? How do you coordinate spousal benefits? And really, how does this tie into the best long-term strategy for your situation? And with all of that in mind, how should your investment allocation change as a result of this? Obviously, especially more recently with the tailwinds from the markets, it's been a big positive for everyone. But looking ahead, looking into the future, what type of return assumptions am I using for my portfolio? And do any changes need to be made to help maximize my income and really capture what's best for me and my family? Because the help that's available through the Social Security system itself, I wanted to point out, what can the personnel of the Social Security office help you with, and what can they not help you with? So what they can do is they can help estimate individual benefits, so they can help give you a ballpark on what that amount's going to be, and they can tell you the amount that you're entitled to now. What they cannot do is project future benefits through scenario planning, and they cannot help with any strategies or make any recommendations around what they think is best for you. So essentially, the personnel at the Social Security office can give you very factual information, but they cannot make any recommendations or provide any strategies. So before Bijal closes out, I wanted to pull up one last slide here. So for everyone that's attended today, we've got resources and tools on our end to provide a full Social Security analysis. And so what we're going to do on a complimentary basis for everyone that's attended today is we've got a 30-page personalized report that's going to help recommend the claiming strategy, help maximize your benefits. It's going to help compare certain strategies against one another so you can see the difference. And it's going to provide specific claiming instructions along with colorful graphs and charts to really try and demystify this decision around Social Security. So Bijal's going to talk about, how that's going to work. And then what we're going to do at the end is we'll close out with questions. We've got a lot of questions in the queue, and we're going to try and hit as many of them as we can in the last 10 minutes or so.
Thanks, Adam. Before we get to questions, I want to make some quick closing comments. On behalf of Bernie Wealth Management, we want to thank you for your time this afternoon. We hope it was as valuable and educational as we anticipated. Kyle McFarland from our team will be reaching out to you over the next several days to schedule a complimentary Social Security analysis with a senior wealth advisor and to address any outstanding questions you may have. The Social Security analysis will provide you with the recommended Social Security claiming strategy based on your personal circumstances. Kyle's email is now shown on the screen in case you'd like to contact him directly. I'll turn it back over to Adam to tackle some of your questions.
Okay, we've got a couple of questions. I'm trying to scroll through and see where we have overlap. We've got a lot of questions in the queue, and a couple here related to Medicare and how that coordinates with Social Security. So I'm gonna knock this one out first. The question is, can you enroll in Medicare at 65, refrain from claiming Social Security until 70, and still receive the delayed credit? So obviously, we know Medicare at 65 is something that typically needs to be done. So can you just claim your Medicare and keep delaying Social Security? The answer to that quick one, yes. So you can take Medicare without Social Security, but I want you to know that you cannot do this the other way around. So if you file for Social Security and when you do this, you must enroll in Medicare at least Part A. So good question. Another one here about the repayment of benefits. So this particular individual reference being born in December of 52, and wanted to note that he could repay his total Social Security benefits received to date and then refile to obtain a higher current payout. So, and I've seen this over the years, a lot of clients, they'll start claiming at a certain age, and for whatever number of reasons, they feel like they made the wrong decision, or they want to make this a retroactive thing and try and turn those delayed credits back on. And this particular client, several others are asking if you can do that and how so. The rule around this is that if it's been less than 12 months since you filed, you can withdraw your application and then repay the benefits that you received to date. You do this through a form on the Social Security website. I think it's 521, but you actually don't need to work with the Social Security office in doing this. So you don't need to have any FaceTime with them. You just fill out this form and apply it and retroactively pay. And then what happens is you can just keep, delaying your credit. So I would say maybe let's talk about that a little bit more before you consider that as a strategy. But it can be done. Another one here, if someone has not filed for their benefit and at 64 or some earlier age you're diagnosed as terminally ill, are there any retroactive payments available? So again, let's say your plan was to wait till full retirement age, and then between 62 and 66, let's say, you're diagnosed as terminally ill. Some people want to know, are retroactive payments available? And are they able to receive any special provisions of benefits due to being diagnosed within, with less than 12 months to live? So a lot of moving parts here, but I think it's important to note there's no retroactive benefits payable prior to your full retirement age. A person with a terminal illness, what they should do is apply for disability benefits ASAP. It takes a few months to qualify, but I believe benefits are paid back to the date of application. So if there's any, terminally ill diagnosis, you cannot, if there's no retroactive payments, especially on a multi-year basis, that'll be available. So that's three. we're just up on a full hour now, looking at the clock. What I want to do is we've got access to all of your questions, and we should have everyone's email address. So your questions will not go unanswered. We'll tackle them individually. When you work with Kyle, we'll incorporate your personal questions as part of this. So I know it's a Monday, and it's either early in the morning or lunchtime for most of you. So we'll let you go on your way. We thank you again for your time. And I will leave the last slide up on the screen for a bit so you've got the contact information you need. But really appreciate everyone again, and enjoy the rest of your week.